Puneet, thankfully the Omicron impact was rather short-lived, which clearly sets your expansion plans back in full swing. What's the update, as you plan to sign around 17 new hotels, I understand?
So our new age businesses give us margins north of 50%, which is unheard of in the typical traditional hospitality business. Having said that, they do form a very low percentage of our revenue today. So our focus will be in how to scale up these businesses. That's number one. Number two, our growth was what we had committed to a hotel a month with the opening of the Ginger in Kochi today. We have done more than a hotel a month in this current financial year, and we think going forward on the basis of the pipeline numbers we have today, if there was no fourth or a fifth wave or no further lockdowns, we expect to open anywhere between 16 to 20 hotels, another maybe 50 to 75 homestays, a few more QSRs. So our growth journey is definitely very, very strong, and it's based on a fee-based model. So no capital upfront expenditure from us. I think we are very, very happy to share that, and we have given this kind of guidance before. And despite the pandemic, we've been able to walk the talk. So I see no reason that why we should not be able to increase that number from one hotel a month to at least 1.5 hotels a month.
Pankaj, but the problem with these fashion retailers, and I'm purely picking up the apparel ones right now, first is that it's a very limited space. I mean, you have a wide range from a Shopper Stop to a Trend to an Aditya Birla Fashion, players like a TCNS. I mean, I'll include VMart also, chalo, in that, Go Fashions and Vedant Fashions, for instance. So A, wide scale, B, very limited few players, and C, all of them have run up already so much. For someone who's actually jumping into the trade only now, I mean, year to date, most of these stocks have already given you 34, 20% kind of returns. Won't valuations be a concern?
One will have to look at stock specific. Reality is that if I were to look at what can these companies do 5 years down the line, some of them are growing at 20-25%, some are growing at 10 to 15%. There are companies which have 30 to 40% EBITDA margins and ROCs which are great. Those companies are already getting richly valued, but the growth may sustain those valuations. On the other side, there are certain companies which got beaten down because in COVID, people thought that, with COVID plus online retailing coming back, and most of the retailers having fixed costs, whether they will survive or whether they can get their act together. Now, those are places where there may be deep value, where an investor can make a call on whether these companies will be able to embrace Omni the way customers will want going forward, and take a call. And hence, there would be value available in some of these companies that you spoke about, even though they've gone up by between 25 to 50% over the last year.
I'm also looking at your latest research note, and you've also talked about Interglobe Aviation as well as HPCL being in a slow lane. Why Interglobe Aviation? Because at a time when you've got international air travel as well resuming, sure enough, ATF prices are going to get higher, but so is the demand. And there's so much pent-up demand that, some of the local airports are almost looking like a bus station.
Yes, but at the same time, prices can't be raised completely in line with the elevated costs, but it will be a case of too much too soon. And there will also be probably some watchdog regulator government pushback if the prices go up too soon. And it will also impact demand. So we have just taken everything together, and a composite picture seems to be that the input cost inflation has been too sudden and too sharp. And if it lasts for a couple of years, the earnings will be very badly hit in Interglobe. And the other stock, which was the one that you mentioned, HPCL. So HPCL, oil marketing companies will also have a problem that, if crude stays very high and they need to raise the pump prices to make whole, that might be inflationary. There is an RBI study that every $10 of crude increase, if it is completely passed on up to the pump prices, then the inflation is up overall by about 50 basis points. So there is a $30-40 increase in crude prices, then we are talking of that alone contributing 1.5 percentage points to CPI inflation. And that might be something that the government doesn't allow. And therefore, there could be a lid on the prices. And then, if you look at it that way, then the OMCs become far from commodity companies, they are commodity consuming companies. So they have a lid on pricing and they have no control on cost. So their earnings should be the most vulnerable.